Hey everyone, Dan Russo, Chief Market Strategist at Chaikin Analytics, coming to you with some thoughts highlighting one of the interesting dynamics that I pointed out in my morning note today to our clients. Every Wednesday, I look at market sentiment and look at some of the different metrics that we can use to gauge market sentiment. And one of the ones that I like to use is the CBOE Equity Options Put Call ratio, right? Just a ratio of the number of puts or the volume of puts relative to the volume of calls trading in the market. And I smooth it out with a 13-day moving average. And what's really interesting to me is that 13-day moving average continues to be, it's been in a position of extreme greed for the past few weeks, actually surpassing the levels that we saw at the market top back in January and February of this year. We started pointing it out a couple of weeks ago in our notes, and actually back on June 9th, we started calling out the fact that the market looked a little extended in the near term, and we wouldn't be as surprised to see a pullback in the S&P 500 to the 3,000 to 3,100 level, and that's largely where we find ourselves now. But what's interesting to me is that put-call ratio remains dogmatically greedy, or investors remaining, or options investors remaining extremely bullish. And I'm contrasting that with what I'm seeing in positioning in the S&P 500 futures. Right? If I look at the net positioning of large and small speculators in the S&P 500 futures contracts, they remain net short. Right? I'm trying to figure out what's going on here. My initial thought is that the day trading crowd or the retail traders are expressing their view in the options market, while the more institutional investors are expressing their bearish view in the futures market. Now, those futures could be hedges against a long stock portfolio, but I do find it interesting that there is this big bifurcation playing out in the market. When we were at the March lows, the put-call ratio, the 13-day moving average of the put-call ratio was excessively fearful, and speculators' net position was excessively bearish. Now, the options traders have become extremely bullish, while the futures traders have remained bearish, not to the extreme that we saw in March, but still remaining bearish. I don't know how this is going to play out, but I think it's one of the more interesting dynamics at play here in the market, and it's an interesting exercise as we look at sentiment. Now, sentiment's interesting to me only at the extremes, and I would argue that put-call ratio is currently at an excessively bullish extreme, which would line up with further choppiness in the market here. Now, over the weekend, we pointed out that we thought that the risk-reward in the S&P 500 was roughly balanced. We remain with that view. We're going to have to see how it plays out. For us, a break to the upside of 3,200 opens the door to the February highs, but a break of 3,000 to the downside likely sets us up for a move down to about 2,850. In between, I think it'll be easy for traders to get themselves chopped up. We're just watching it at this point and waiting for those key levels to break one way or the other. But positioning is really interesting because somebody is likely going to be very offsides. That was something that I found really interesting as I was doing my work today. I wanted to call it out for you. Hope everybody's having a great Wednesday. Be back to you soon.